Have you ever been in a conversation about, the stock market and just felt completely lost? If so, you're in the right place. We're going to break down smart investing. No jargon, I promise. Just the absolute basics to get you started.
Real talk, this was totally me not that long ago. Someone would start talking about their portfolio and my brain would just fuzz out. I just did not get it. And honestly, that feeling is way, way more common than you'd think.
So, if any of that sounds familiar, you are in exactly the right place. Because, let's be honest, for most of us, nobody ever actually sits you down and teaches you this stuff, right? Well, today, that is exactly what we are going to do.
Okay, so first things first, we have to tackle the most fundamental question of all. Why can't you just stick your money in a savings account and call it a day? Yeah, seriously, why bother with all this? Well, here's the uncomfortable truth. That cash you have sitting in the bank, it's not actually safe. It's losing its power, its value, every single day. And the reason why is this one sneaky little concept called inflation.
So to put it really simply, inflation just means that over time, stuff gets more expensive. Your morning coffee, the gas in your car, your groceries, all those prices creep up. But that dollar you saved last year, well, it's still just a dollar.
So here's how to think about it. That $1,000 you worked so hard for and tucked away, in just a few years, it's going to buy you less than it does today. It really is like a silent, slow leak in your financial bucket. So what's the solution? Well, this is where investing comes in. It's how you fight back against that silent leak. It's how you turn your money from something that's just sitting there, shrinking, into an active tool that's actually working for you, hopefully growing faster than inflation can eat away at it. Okay, so maybe you're convinced. You get it. You need to make your money work. But what do you actually do? What do you invest in? Let's break down the big options in the simplest terms I can. First up, the big one, stocks. When you buy a stock, you are literally buying a tiny, tiny piece of a company. Think Apple or Tesla or whatever. If that company does well, your little piece becomes more valuable. If it does poorly, well, it goes down. So it can be high risk, but also high reward. Next up, we've got bonds. Now, the easiest way to think about a bond is that it's just a loan. You're lending your money to a big company or even the government, and in return, they promise to pay you back plus a little extra in interest. They're usually safer than stocks, but that also means they tend to grow a lot slower. Then you've got something called a mutual fund. Imagine a giant swimming pool of money. A whole bunch of people, just like us, all throw their money into the pool, and then a professional manager dives in and invests that whole pool of cash for everyone. It's a pretty great hands-off option if you're just starting out. And finally, we have what's honestly my personal favorite for beginners, ETFs. That stands for exchange-traded funds. Think of it like buying a whole basket of groceries at once, instead of just one apple. You get a little bit of a lot of different stocks all in one purchase. This gives you instant diversification, which is just a fancy way of saying you're not putting all your eggs in one basket. Okay, now we get to the part that, honestly, it completely blew my mind when I first understood it. This is the secret sauce. It's the magic ingredient that makes long-term investing so powerful. This quote from Einstein really nails it. Put simply, compounding is when your money makes money, and then the money that your money made starts making its own money. It's like a snowball rolling downhill. It starts small, but it picks up more and more snow, getting bigger and faster as it goes. Look at that number, over $500,000. Does that seem completely impossible for a normal person? Well, let me show you how it actually works. Look, this isn't some kind of magic trick, it is just math. If you start at age 25 and just invest $100 a month, by the time you're 65, you'll have put in a total of $48,000 of your own money. But because of that compounding snowball effect, it could grow to over $500,000. Think about that. The money your money made more than you did. So what's the most important ingredient here? It isn't having a ton of money to start with. It's time. The more time your money has to sit there and work and grow and compound, the bigger that snowball gets. Seriously, starting even just 1 year earlier can make a massive difference down the line. Okay, so that's the why you should invest and the what you can invest in. But now for the most important part, right? The how. Let's actually build a super simple, actionable plan that you can use to get started, like today. Okay, step 1, you need a why. What's your goal? Is it for a down payment, retirement? Write it down, make it specific. Step 2, start simple. Seriously, don't try to pick the next big, perfect stock. Instead, look at something like a broad index fund or an ETF. A really common one just tracks the S&P 500, which is basically a basket of 500 of the biggest companies in the US.
And hey, you don't have to take my word for it. Warren Buffett, probably the most famous investor on the planet, says this is the smartest move for the vast majority of people. And it makes sense, right? Instead of betting on just one company to succeed, you're basically making a long-term bet on the entire US economy to grow over time.
Now, hang on. Before you run off and open an account, we need to talk about the mistakes to avoid. Honestly, knowing the common traps is half the battle, and I really want to help you sidestep the same mistakes that I and so many other people have made. Okay, first big one. Don't try to time the market. Nobody, and I mean nobody, can predict the perfect day to buy or sell. Just don't even try. Second, don't panic when things go down. The market will have bad days, bad weeks, even bad years. It's totally normal. Selling when you're scared is the fastest way to lose money. Third, we already talked about this, but don't put all your eggs in one basket. And last, but this one is absolutely critical, have an emergency fund saved up first. We're talking 3 to 6 months of living expenses, safe in cash, before you invest a single penny. I know we've covered a lot, and it can definitely feel a bit overwhelming at first. But I want to leave you with one last, really important idea. You know, one of the biggest myths out there is that you need a lot of money to start investing. You absolutely do not. You can start with $20, you can start with $5. The amount you start with matters so much less than the habit of doing it. Just starting and then doing it consistently, that is what builds real wealth over time. At the end of the day, investing isn't about getting rich quick. It's not a lottery ticket. It's about building a better future for yourself slowly, patiently, and letting time do most of the heavy lifting. You've already taken the most important step just by being here. So as you go from here, I'll leave you with one question to think about. What's your single biggest question about investing right now? Figuring that out, well, that's your next step on this journey.